There is a story developing in real time in the global gold market that Western financial media has almost entirely ignored, not because the data is hidden, not because the regulatory filings are classified, but because the pieces are reported separately in different contexts by different outlets with different audiences, and nobody is connecting them into the single coherent narrative they represent. I want to connect them today because what China has done in the gold market over the past 18 months constitutes, in my assessment, after 5 decades managing capital at institutional scale, one of the most significant sovereign monetary positioning moves since the United States closed the gold window in 1971. The scale is measured in the tens of billions of dollars. The institutional architecture is permanent. The investment horizon is measured in decades, not quarters. And the implications for gold prices, for the dollar's reserve status, and for the monetary transition that is already underway are being entirely missed by the majority of Western investors who are watching COMEX futures prices and interpreting them as the whole story. They are not the whole story. They are barely the beginning of it. Let me show you what is actually happening beneath the surface and why the investors who understand it are positioned fundamentally differently from those who are not. Here is what happened. And more importantly, here is why it happened and what comes next. The program that moved $27 billion, quietly, China's financial regulators authorized a program permitting 10 of the country's major insurance companies, including PIC, China Life, and other institutions managing assets measured in trillions of renminbi, to allocate up to 1% of their total assets into gold. 1% sounds modest. The number it represents is not modest at all. 1% of the assets managed by China's major insurance companies represents approximately $27 billion of potential gold investment. That figure is the floor, not the ceiling. The regulatory framework that established this program explicitly contemplates extension to additional institutions. The percentage allocation may be increased as the pilot demonstrates results. Half of the participating companies have already begun deploying capital. The industry is nowhere near its authorized ceiling. To put the scale in context, total global gold ETF outflows in a recent major market dislocation, a period widely covered in Western financial media as evidence of gold selling, were approximately 43 tons. China's insurance company program, at its authorized limits, represents demand that would absorb years of global mine production, and this is one program from one category of institutional investor in one country. UBS analysts traveled to China specifically to assess this program on the ground. What they found when they examined the data directly confirmed both the scale and the durability of what was happening. Chinese gold ETF inflows remained robust throughout a period when North American ETF flows were significantly negative. Trading volumes on the Shanghai Gold Exchange increased materially. The Shanghai premium over COMEX paper prices stayed elevated, meaning Chinese buyers were willing to pay more for physical gold than the Western paper market price would suggest, a signal of physical demand intensity that the paper price was failing to reflect. The program has not yet reached its authorized limit. The capital that has been approved to flow into gold has not yet fully arrived. What we have observed so far is the opening phase of an accumulation program, not its completion. The scale of what is coming dwarfs what has already occurred. Why insurance companies and why this matters more than central bank buying? Most coverage of China's gold accumulation focuses on the People's Bank of China, the central bank that has added to its official gold reserves for more than 18 consecutive months. That story is real and significant, but it misses what I believe is the more structurally important development. Insurance companies are among the longest duration investors in any market on earth. Their liabilities extend decades into the future. They match those liabilities with assets selected not for short-term performance, but for long-term stability, reliability, and purchasing power preservation. When an insurance company builds an allocation to any asset, it does not build it and sell it in response to a quarterly earnings report or a change in market sentiment. It builds it, holds it, adds to it systematically, and treats price volatility as a procurement opportunity rather than a signal to exit. This is a distinction that makes the Chinese insurance company program qualitatively different from the Western paper gold market activity that generates most of the headlines. When a leveraged hedge fund in New York buys COMEX gold futures, it is making a position that can be forced to close by a margin call, a risk management review, or a portfolio reallocation. The average holding period for institutional futures positions is measured in days or weeks. When a Chinese insurance company building a gold allocation buys physical metal, it is making a commitment measured in decades. The transfer that is occurring between these two categories of holders, from leveraged Western paper holders to unleveraged Eastern physical holders with generational time horizons, has a name in market structure analysis. It is the transfer of assets from weak hands to strong hands. And every time this transfer occurs, two things happen simultaneously. The pool of gold available for future forced selling decreases, and the base of committed long-term holders grows. The implications for future price dynamics are not subtle. The geopolitical logic beneath the financial structure. Understanding why China has made this move requires understanding a single event that changed the sovereign risk calculus of every treasury and central bank on the planet permanently and irreversibly. In February 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves in response to the invasion of Ukraine. The legality, the justification, the strategic necessity, these are separate questions that I am not going to adjudicate here. The consequence, the one quietly reverberating through every sovereign wealth fund and central bank in the non-Western world since that moment, is this: dollar-denominated reserves held in Western institutions are subject to political discretion. They can be frozen. They can be made inaccessible through a digital instruction to a correspondent bank. The rule of law protection, that was the foundational assumption of dollar reserve status, the assumption that made the dollar the world's preferred reserve currency for 70 years, was shown to be conditional on geopolitical alignment with Washington, not conditional in theory, conditional in practice, demonstrated by a specific action with a specific dollar value visible to every central bank governor on earth. Every sovereign that processed this information drew the same rational conclusion: if your national wealth is held in a system controlled by a potential adversary, that wealth is not fully yours. It is yours so long as your relationship with a custodian remains aligned. The moment that alignment breaks, your reserves become a liability rather than an asset. The question every central bank has been quietly asking since February 2022 is not whether this could happen to them. The question is how much of their reserves they want to hold in a form where it could. Physical gold held in domestic vaults is subject to no foreign government's discretion. It cannot be frozen by executive order. It cannot be sanctioned. It cannot be made to disappear by a digital instruction to a financial intermediary. It sits in a vault, it belongs to its owner, and no geopolitical development changes that relationship. China's insurance company gold program is the institutional expression of this realization, implemented at the level of the country's largest long-duration investors. It is not a bet that gold will appreciate. It is the construction of a monetary reserve position that exists entirely outside the vulnerability that the Russian sanctions demonstrated. The financial and the geopolitical are not separate stories. They are the same story told from two different angles, pointing to the same conclusion. The paper market and the physical market are telling opposite stories. Here is the analytical distinction that separates investors who understand the current gold market from those who are reacting to the wrong signal. The gold price you see quoted on your terminal, on financial news networks, on your brokerage platform, that price is set primarily by the COMEX Futures Exchange in New York. COMEX trades paper contracts representing 100 ounces of gold each. Approximately 95% of these contracts never result in physical gold changing hands. They are financial instruments, claims on gold, not gold itself, traded by hedge funds, algorithms, and investment banks operating with significant leverage. The physical gold market operates differently. London's LBMA vaults, the Shanghai Gold Exchange, direct central bank transfers. These markets trade actual metal that actually moves. They are less liquid, less visible, and far less covered in Western financial media, but they contain the signal that actually matters for long-term price direction. During the most recent period of significant paper market pressure, when COMEX futures were being aggressively sold by leveraged funds facing margin calls, something structurally important was happening in the physical market simultaneously, and in the opposite direction. COMEX registered inventory, the gold actually available for delivery against futures contracts, fell approximately 25%. Physical gold was leaving the system at an accelerating rate at precisely the moment the paper price was most suppressed. Physical gold does not disappear because a futures contract was sold. The metal is real, the paper claim is not. When paper prices fall and physical demand simultaneously accelerates, the paper market is mispricing the asset relative to its physical reality. This divergence is not sustainable indefinitely. The physical market signal ultimately dominates. The history of gold market dislocations is consistent on this point. Chinese institutional buyers understood this. During the same period when Western retail investors were interpreting paper price declines as evidence that the gold thesis had broken, Chinese insurance companies and Chinese ETF investors were accumulating physical metal at what they correctly identified as a procurement discount. The price that was generating fear in the West was generating purchases in the East. This asymmetry, Western paper selling, Eastern physical buying, is the structural dynamic that defines the current market, and its implications compound over time in ways that are not yet fully visible in the paper price. Three structural forces that will not reverse. I want to be direct about why I believe the move China has made is not a trade that will be unwound at a higher price. It is a structural reallocation that reflects three forces, each of which is intensifying rather than dissipating. The first is the de-dollarization of global central bank reserves. The dollar share of global central bank reserves has declined from 71% in 2001 to under 58% today. This decline is gradual, consistent, and driven by rational diversification away from a reserve system that the Russian sanctions demonstrated is subject to political discretion. Gold is the primary alternative, the only reserve asset that carries no counterparty risk, cannot be sanctioned, and exists entirely outside the control of any government's financial system. Central bank purchases globally reached over 1,000 tons in 2025. The buyers include Poland, India, Kazakhstan, Brazil, Turkey, the Czech Republic, countries across entirely different political systems and economic models arriving independently at the same allocation decision. When institutions of this diversity converge on the same asset, the convergence deserves serious analytical weight. The second is the fiscal arithmetic of the United States government, which creates a structural dollar tailwind for gold regardless of what China does independently. The national debt approaches $40 trillion. Annual interest payments have crossed $1 trillion, exceeding the entire defense budget. The deficit is running at approximately $2 trillion per year and growing faster than the economy. The only realistic resolution path that avoids explicit default runs through sustained monetary accommodation, lower real interest rates, more money creation, and a structurally weaker dollar. Every one of those outcomes is a mechanical tailwind for gold priced in those depreciating dollars. The third is the insurance company program itself as an expandable model. Regulatory pilots in China that demonstrate stability and positive results get extended. Additional institutions get included. Percentage allocations get increased as the pilot matures and proves itself. The $27 billion figure that represents the current program's potential is not the ceiling. It is the starting point of what is designed to be a permanent growing allocation across the largest long-duration investor category in the world's second largest economy. What the Western media is missing and what it costs you, the reason this story has received minimal coverage in Western financial media is not malice, it is structure. Western financial journalism is oriented toward COMEX price movements, Federal Reserve policy decisions, and the behavior of large institutional investors in New York and London. The regulatory decisions of Chinese financial authorities regarding insurance company gold allocations are reported in Chinese regulatory filings, processed by specialized analysts, and do not generate the kind of immediate price movement that drives mainstream financial coverage. But coverage frequency and investment significance are not the same thing. Some of the most important developments in financial markets are the ones that generate the least immediate attention precisely because their mechanism operates over years and decades rather than days and weeks. The Chinese insurance company program is a 20-year story, not a 20-day story, and the investors who understand it as such are positioned differently from those who are monitoring COMEX daily price movements and reacting accordingly. Goldman Sachs analysts who examined this development alongside their broader gold thesis described the Chinese regulatory move as one of the most structurally significant demand developments in the gold market in years. not because of the immediate capital deployed, which is substantial, but because of what the institutional architecture of insurance company allocation means for the durability and predictability of that demand over the long term. When Goldman Sachs, UBS, and JP Morgan's research teams all converge on the same structural conclusion about an asset at the same time, and that conclusion is based on the same underlying data, the Chinese program, the central bank accumulation figures, the COMEX physical inventory decline, the paper physical divergence, it is worth examining whether your own portfolio reflects the same understanding. The answer to the question you should be asking, the question most investors ask when they encounter this information is, what do I do with it? The answer is not complicated, though its execution requires discipline that runs against some deeply embedded reflexes about how to think about portfolio management. The primary reflexes to resist are two. The first is the reflex to interpret Western paper market price signals as the definitive measure of gold's value. When the physical market, where China and other long-duration institutional buyers are actually accumulating, is telling a consistently different and more structurally significant story, the second is the reflex to treat the absence of coverage in mainstream financial media as evidence of insignificance when the mechanism I have described operates precisely because it builds slowly, quietly, and with a time horizon that does not generate daily headlines. The structural reality is this: China has made a 20-year allocation to physical gold through the institutional architecture of its largest insurance companies. Central banks globally are buying at the highest sustained pace in modern history. COMEX registered inventory is declining. The paper market is losing its capacity to suppress prices indefinitely against a physical market that is systematically accumulating. The biggest gold move in history is not a single day's price action. It is the construction of a structural demand base by the world's second largest economy through institutional channels that are designed to hold for decades, not for quarters. It happened quietly. It is still happening. And the investors who understand its significance before it becomes obvious in the price are the ones who will look back on this period the way the investors who bought gold in 1970 look back on their decision, not as a trade they made, but as a structural understanding they arrived at before the market did. The data is public. The regulatory filings are available. The institutional behavior is documented. The only question is whether you are paying attention to the right signals.